Hi everyone, welcome to Shipra Academy's fast track course on CA Inter Auditing. Today we are going to cover Chapter 3, Risk Assessment and Internal Control. It's going to be a non-stop class. If there is any questions, you can interrupt in between. Okay, so risk assessment and internal control, this is one of the key topics which is actually a problem for a lot of students because of the complexity of the topics, or maybe the subject is difficult for them to swallow. So now we are going to make it easy by giving examples and easy to understand topics so that you are able to easily understand the concept and remember it for long. So what are all there going to be there in the chapter? So meaning of audit risk and variables affecting it, and risk assessment procedures, materiality in planning and performing the audit, understanding the entity, meaning, objectives and limitations of internal control, components of it, and whether all the controls are relevant to an audit, nature and extent of the understanding of relevant controls, risks, and then internal control system benefits, testing of internal control. So it's going to be a huge variety of topics related to risk assessments and internal control. And you're going to look at types of internal control, data analytics, a lot of things. So let's go through the first topic. So the chapter overview, you can see that risk assessment and internal control in the center, being covered by audit risk, identify and assess risk of material misstatement. This we call it as ROMM, risk of material misstatement. You need to write it down, ROMM. Risk assessment procedures, and then understanding the entity and its environment. So digital audit, what are all the things surrounding it? You can see automated environment, IT related risk, IT controls, and impact on controls, IFC or ICOFER, internal financial controls, testing methods, data analytics, and few essays 315, 320, and 330, which will be covering it later in the topic. Okay, so this particular item is going to be an example. So this I would leave it for you to study at a later point. We will give our own examples, which is easy for you to understand. So now, first getting into the topic, audit risk. What is audit risk? Audit risk means that the risk that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. So, what is the purpose of doing an audit? To give an opinion. And if the opinion is actually wrong, then it's going to be an issue. So, if what are the two types of opinion can be given? One is that it's going to be on a broad level. I'm just going to look at it. Okay, I'm not going to get into the audit reporting and the different types of audit reports. On a broad level, the auditor is going to say that yes, everything is giving a true and fair view, or no, it is not giving a true and fair view. There is some issues with it. So now, when you look at this stage, if all the financial statements are correct and everything is fine, but still the auditor is giving a wrong opinion, saying that it is not giving a true and fair view, that particular topic we are not going to get covered here. Because if the auditor is going to say that something is wrong, then the auditor's duty is to counter argue and give the auditor all the facts and evidences and prove that the auditor is wrong and say that everything is there. So that will be almost taken care. So it is not going to be a huge risk because the auditors are there to protect it and make sure that they get the right report. Okay. And if the auditor is still saying that, then there is something called as negligence that we'll look at it later. So now from our audit risk point of view, the risk is that the opinion is given and the opinion is wrong, means there is a misstatement in the financials, but the auditor has not looked at it and not commented or given an opinion on it. He's saying that everything is true and fair. This is what is going to create a issue for the readers of the financial statement, not the first one what we discussed. So the readers of the financial statements are not trusting the owner of the company or the shareholders of the company or the board of directors of the company or the CEO of the company or the CFO of the company. They are only trusting the auditor. That is why they will always ask for audited financial statements. Say for example, banker will ask, give me the audited financial statements. So when everybody is asking for audited financial statement, that is, they are giving a kind of weightage for the auditor. We will trust the auditor. Now, if the trust is broken, that is the auditor, they are trusting on the auditor, but the auditor is not giving the right opinion. So they are believing that everything is correct based on the auditor's opinion, but the auditor has given a wrong opinion. Actually, there is some ROMM. Actually, there is some not ROMM, not a risk. Actually, there is a misstatement. ROMM means risk of material misstatement. that we'll do to plan and assess. Actual misstatement is there. So actual misstatement is there, but the auditor has not captured it and given an opinion on that. Then it's an issue. So that is what we are going to address here as part of audit risk. I hope that is clear for everyone. Okay. So auditor expresses an unmodified opinion. See, unmodified means it's a clean report. Means there is no issue with the report. Unmodified is not modifying anything out of the report. It's a clean report. So in financial statements are materially misstated, but he is giving an unmodified opinion. In such a case, not only the reputation of the auditor would be damaged, but he could also invite regulatory action from professional body and legal action by intended users. So they'll say that, hey auditor, because of your report only we gave 50 crore loan to this company, but you have given a wrong report. But actually there is a lot of misstatements in the financial reports, which you have not identified. So it's a professional negligence, so we will sue you. That can also happen. And professional bodies like ICAI can take action, NAFRA, NFRA can take action, and any other investigative agency, CBI or whoever it is, if it's a financial fraud or crime, they can also take action. That's what they're saying. It's not only a loss of reputation, but also could invite regulatory repercussions. So now, to avoid such consequences, auditor will plan and perform the audit such that the risk is reduced to an acceptably low level. So you need to reduce the risk. Always there will be a risk. You cannot go with a zero risk. Whatever you do, there might be some risk which will be still lying there as a small portion. Say, for example, if you want to ensure that your house is completely safe and secure, you put a lot of locks, you put security guard, you put CCTV camera, but still there is a risk which will lie because somebody can damage a security camera or somebody can bribe the security or the security himself can steal. So something can happen. So the risk cannot be zero at any point in time. So that is what they're saying. You need to bring down the risk to an acceptably low level. Means bring down the risk to a low level, which is acceptable by the auditor. Okay, this is a small risk I can accept. It's not so material. It's not significant. It's not something which is worrying for people. So SA 200 states that the auditor shall obtain sufficient appropriate audit evidence to reduce the audit risk to an acceptably low level and thereby enabling the auditor to draw reasonable conclusions on which to base the auditor's opinion. Means you need to get all the appropriate audit evidence so that you bring down the risk to a low level so that you can draw reasonable conclusions so you can base your opinion. I hope that is clear with this concept. So with that, we are going to move forward. ROMM, risk of material misstatement. What is that? It simply means that there is a probability of frauds or errors in the financial statement before the audit. So before the audit is getting started, the auditor is realizing that there is some kind of a risk of material misstatement, which is probability of errors or frauds. Errors means unintentional. Fraud means intentional. So that is the only difference. If somebody is making fraud to mint some money or cheat or deceit or do something with a negative intention, so that is fraud. If it is a system error or if it is somebody by mistake done something, then it's an error. Either of it can lead to material misstatement. What is material misstatement? Is basically the financial statements are stated wrongly, and that too it is not a small number, it is a significant number. It is material misstatement. For 100 crore, 10 crore can be material, but for 100 crore, 1000 rupees might not be material. So it all depends upon case-to-case basis on that particular situation. What is the issue? So what is the number? What is the number we are talking about? What is the number we are auditing? Based on that, the auditor will have to take a call, which will impact the readers of the financial statement. Who is the readers? It can be the shareholders, it can be the directors, it can be the external parties, the collaborators, the competitors, not the competitors, the people who wanted to buy shares, shareholders, potential shareholders, investors, bankers who are giving loans. So all these people are users of the financial statement. Okay, misstatement refers to a difference between the amount, classification, presentation, or disclosure of a reported financial statement item and the amount. Classification, presentation, or disclosure that is required for the item to be in accordance with the financial reporting framework. See, if I give a simple example, you will be able to understand. If I say 100 cars were purchased by the company, where will that be accounted as per the financial reporting framework? Say, for example, Ind AS, or it can be IFRS. People will say that it has to be reported in fixed assets, right? 100 cars were purchased. But if I say that it has to be reported in inventory, you may think no, because If that company is Tata Motors and they are the dealers for cars, buying and selling, then it is an inventory for them. See, that is where you need to understand the business and then you need to apply the financial reporting framework. Then only you'll be able to get the right answer. That is why a professional is required to assess whether it is in accordance with the reporting framework or not. So it depends. Somebody who wants to make fraud, they wanted to show some 10 crore as depreciation and reduce the profit. Instead of putting that 100 cars in the inventory, which doesn't require a depreciation, they'll put that 100 cars in the in the fixed assets, and in fixed assets they'll claim depreciation and they'll say that the profit is reduced. So they can intentionally do the fraud and they'll still come back and say, as per the financial reporting framework, I can report car under fixed asset. But as an auditor, we need to understand what is the business they are operating and whether this is the right way to book the numbers or not. So that is where the professional judgment and skepticism and all those things are required. Okay, having understood that, let's go forward. What are the examples of misstatement? You would already know. Charging an item of capital expenditure to revenue or vice versa. This is the same example which we gave between inventory and fixed assets, or maybe you are purchasing a small item and capitalizing it instead of booking it to P&L. So all those things. Financial statement item versus applicable. Okay, difference in the disclosure of a financial statement item vis-a-vis its requirement. So financial reporting is saying something, but you are disclosing it differently, or you are not even disclosing it. Inappropriate accounting policies. There can be an accounting policy for bad debt, but you are not using it appropriately. Last year you did a different depreciation, say straight line method. This year you are using a WDV or accelerated depreciation. So those kind of changes in accounting policies and fake expenses you're booking. So all those things are basically misstatements. If that number is actually significant, which is material, then the auditor will have to catch it. The auditor will have to catch everything. There's no doubt about it. But he will not be pointed fingers if there is something small amounts here and there which are being overlooked by the auditor, because the auditor is not going to do 100% review. The auditor is only going to do a sample check and sample review. Okay. Risk of material misstatement may exist at two levels: the overall financial statement level and at the assertion level for the classes of transactions, account balances, and disclosures. So the two level, overall financial statement level. Okay, this is a 100 crore balance sheet. So my material misstatement, I'll fix it at 2 crores, which is 2% of the balance sheet. So anything beyond 2 crores, I'll report it to the readers of the financial statement. The auditor is fixing. But still, there is one more level you need to fix a materiality, which is the performance materiality. Or you can see that at the assertion level for classes of transactions, account balance. Say for inventory, my materiality is say 50 lakhs. For at the same time, for income tax, GST, and taxes, my materiality is zero tolerance, or maybe 1,000 rupees. Anything beyond 1,000 rupees, I'll report it, because I'm very sensitive to legal issues and lawsuits and tax-related cases. So anything which is more than 1,000 rupees as an issue between income tax and GST and other things between my books and their requirements, then I'll report it. So the auditor is fixing a different amount as materiality. Why materiality is fixed? Anything is crossing that amount, the auditor will have to report, or will have to investigate, find out the reason, and make sure that the management is fixing them. So the two types are overall financial statement level and at the assertion level. Assertion means what? Each one will have a, like say at the financial statement level, assertions, say for balance sheet items, P&L items, and for notes to accounts, you'll have disclosures. You'll have different types of assertions, say completeness, accuracy, existence, occurrence, presentation. All those things are the assertions. So for each assertion, say for example, if you take inventory has to be valued correctly. It is one assertion, valuation. Okay. Inventory is existing there in that physically in that premises. That is another assertion. Right. Inventory is accurately being reported. That is another assertion. So all these are assertions. So assertion level also the auditor can set the materiality. Valuation level, my materiality level is 50 lakhs. But accuracy level, my assertion is at, let's say my materiality is at 1 crore. We can fix it at that level also. These are all determined to, these are all assessed in order to determine the nature, timing, and extent. We call it as nature, extent, and timing, NET. Okay, NET is a short form, nature, extent, and timing of the further audit procedure. Based on these things only, the auditor will decide what is the nature of procedures he is going to do, what is the extent, how depth he is going to do, and what is the timing of the procedure, whether closer to the financial close date, 31st March, or whether any time or during interim. So all these are the timing to obtain sufficient appropriate audit evidence. This evidence enables the auditor to express an opinion on the financial statements at an acceptably low level of audit risk. Okay, now we look at components of ROMM. The two components of ROMM are inherent risk and control risk. Okay, so basically, when we put audit risk, you can write the equation. Audit risk is equal to CID. Okay, control risk, inherent risk, and detection risk. CID. Maybe I can write it in the. If I can take a pen marker. Okay. I'll start sharing the whiteboard. Okay. Okay. Audit risk is equal to control risk into inherent risk into detection risk. So basically, CID is a short form. So who is auditor? Auditor is a CID. You know CID is right, easy to remember. So CID or CBI earlier they called as let's say CIDs. So auditor will have to do investigation or like say kind of thing. So it is easy to remember CID. C for control risk, I for inherent risk, and D for detection risk. You can also convert this formula, simplifying it. Control risk into inherent risk is equal to ROMM, risk of material misstatement, into detection risk. So basically what are we saying? Control risk and inherent risk put together is called as risk of material misstatement. Who is actually taking care of these two? Inherent risk and control risk are basically in the hands of ROMM, is in the hands of management to take care. Take care of these things. But detection risk is in whose hands? Auditor will have to take care. Okay, so it is basically the auditor's duty in terms of reducing the detection risk to a lower level. So audit risk is equal to CID and audit risk is equal to ROMM to detection risk, and ROMM is the management who will have to take care of that, and detection risk is that the auditor has to take care of that. So if ROMM is high, okay, what should we do? ROMM is high. Where is the upper arrow? I'm not sure. Okay, so I'll say ROMM is high. Then the auditor has to ensure that the detection risk is low. Means add more audit procedures to ensure that he leaves nothing to be undetected. What is detection risk? Detection risk is that the risk that the auditor is not able to detect a misstatement, error, or fraud or something in the financial statement. So the detection risk will be low only when the auditor is doing more procedures. He's doing more and more procedures, more and more samples, and more timing is spending on the audit procedures. Then the detection risk will be low. So if ROMM is low, say for example, a particular company is not having any transaction during the year. Okay, last year, say for example, during the year of Corona, they are unable to operate their physical store, and the entire year the floor was shut down. There are not much transactions, very limited transactions are there. The auditor is considering the ROMM is low because there is not big changes between the prior year to the current year, and not many transactions are there. So the risk of material misstatement for say for example, sales or purchase and other things are very low. Now in this case, the deduction risk can be high because there is no risk at all in terms of the books itself. Then the auditor can easily do it at a high level review and then he can close it. So he can add few procedures to conclude. Okay, so you can do few procedures to conclude instead of doing a detailed procedures. So this is what ROMM is high or ROMM is low, then deduction risk will be the opposite of that. So based on that, the procedures will be decided. I hope this is clear. You can open up your mic and say.
Yes, sir.
Okay, wonderful. Thanks for that. So now we'll close this and we'll get back to the topic. Okay, where are we? We are in the inherent risk. So what is an inherent risk? Inherent risk is nothing but the susceptibility of an assertion about a class of transaction, account balance, or disclosure to a misstatement that could be material either individually or when aggregated with the other misstatements before consideration of any related control as described in a statement. So basically a simple thing, they have made it too complex because from a book point of view, they need to be covering every aspect of it. Okay, that is why they are putting too many words. So when too many words are put into it, as a student will get confused. So to easily understand this, inherent risk is called as inbuilt risk. If I say, look at the process of collecting the fees from the students for a college. There are two counters, one counter for cash counter, other counter for bank check and IMPS and QR codes and stuff like that. So now UPI payments. So now the two counters, two cashiers are there. Which counter will be more risky? Obviously, you'll say that cash counter is more risky because handling cash is a risk. Somebody might run away with the cash, or the cashier might count a lesser cash, or say they say instead of 5,000, he had collected only 4,000 by mistake, is given a receipt for 5,000. Anything can happen with cash. You know, somebody external can come in and take the cash and run away, or the person who is coming to pay the fees can take the cash and run away, or the auditor can put the cash in his pocket and go out. So anything can happen. So it's more riskier. Handling cash is more riskier. So that is called as the inbuilt risk or the inherent risk in the process itself. Without considering any controls, as a whole, the process itself, whether it is high risk or low risk, we should be able to easily understand. So considering that, if you look at the IMPS way of transaction, the risk is very limited there because the because the cashier is only collecting IMPS and QR code scanning and other thing. Still, there is a risk there, but it is not as high as the cash counter where the cash is handled. So that is how we will be able to understand the inbuilt risk in a particular process. If I say inventory, automatically you'll say the risk is high because anybody can run away with the goods. Inventory pilferage can happen. So a lot of different things are there. So that is what is called as inherent risk. What is the definition they are saying? It is a susceptibility of an assertion. Okay, the way susceptibility, the way it can catch it or the way it can be impacted by it for a particular assertion, for a class of transaction or an account balance or a disclosure to a misstatement that could be material either individually or when aggregated. When you combine it with few other transactions or few other line items, then it is material. So whatever is that, you need to assess them together to see whether the inherent risk is there. Okay, there is always a risk that before considering any existence of internal control in an entity, a particular transaction balance of an account quite made in the financial statement of an entity having a chance of being misstated, and such misstatement can be material. This risk is known as inherent risk. So you need to understand or underline the word. There is that before considering any internal control. So if there is no internal control at all, what is the risk for the process? That is what is inherent risk. Okay. why we are looking at this? This is the first step to find out. Okay, no internal control at all. What is the risk there? Okay. For example, it may be higher for complex calculations. See, there is complex calculation for inventory valuation. Then the inherent risk is high because there is high possibility that somebody can make mistakes. Simple process, easy process, then the inherent risk is low. Okay. So we have spent considerable amount of time here. So we'll move forward to control risk. What is a control risk? Is a risk that a misstatement that could occur in an assertion, the same 3 lines you would have copied. You can see that. Assertion about a class of transaction account balance or disclosure, and that could be material either individually or aggregated with the other misstatement will not be prevented, detected, and corrected on a timely basis by the entity's internal control. So these two, let's say, last line alone is differing. So there is a risk there, and that risk is timely basis by the entity's internal control. That means that you are having an internal control in the system, and that internal control is not effective. Say in that same example of the cashier collecting cash, somebody can run away with the cash at the risk box at the desk, and then you are having a security guard outside who's room, cashier room. That is a second control you have put. These two controls are not operating effectively because the security guard is not coming to the office on time and the cashier is starting. The security guard is going out for breaks. So the security guard is not available. So the control is not effective. So the CCTV camera, somebody has put some kind of a enclosure or something to close the CCTV, or the CCTV camera is not working properly. So these are all the risks that the control may fail. Since the control is failing, the control risk is increasing. Is that clear? Okay. So it is not efficient, not be efficient enough to stop or find and then rectify in appropriate time. Timing is also important. It is detecting after 2 months is not an, you can't say the control is working right. It should be in the appropriate time. Okay. So there is an inverse relation between control risk and efficiency of internal control of an entity. Inverse relation. Control. Control risk is high, efficiency of internal control is low. Means, you are able to hear me?
Sir, it's freezes again.
You are able to hear me clearly now?
Yes, sir.
Is the screen sharing visible?
Uh,
Okay, great. So now coming back to the control risk, yeah.
It's not visible,
You're
sir.
saying something?
The screen is not visible.
Okay. 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 So now you should be able to see the screen in a moment.
Yes, sir, it's visible now.
Okay. Wonderful. So the efficiency of internal control is low, then the risk of control risk is high. Means if the control is not efficient, then the control risk is high. If the control is efficient, then the control risk will be low. That's what they are saying, the inverse relationship. What is the detection risk? We already discussed about it when I opened the JAM board. So in that board, I defined that detection risk means that the auditor has to see the risk of material misstatement. If the material misstatement is high, then the detection risk should be low. If the detection risk has to be low, then the auditor will have to do more procedures. It's again inverse relationship. Detection risk is the risk that the procedures performed by the auditor to reduce the auditors to an acceptably low level will not detect a misstatement that exists and that could be material either individually or when aggregated with other misstatements. The same kind of a detailed explanation, right? So now the example, the auditor uses certain procedures for the purpose of obtaining audit evidence and reducing the risk, but still there will remain a risk that the procedures used by the auditor may or may not be able to detect a misstatement, which by nature is material. Then that risk is known as a detection risk. So we are all talking only about the material risk. Immaterial, say 500 rupees, 1000 rupees for a 100 crore company is not huge material. But if you combine all these items together and if it is coming to 2 crore, then it might be material. That is what you need to be very clear. So detection risk is comprising of sampling risk and non-sampling risk. What is the sampling risk? That the sample is not able to sampling because the sampling is not able to detect the risk. That is a sampling risk. Any other than the sampling is basically the non-sampling risk. So what do you mean by sampling risk? You select, there are 50,000 transactions. Out of that, you are selecting 200 transactions and doing the testing. So the 200 transactions are all clear. There is no issue at all in the transaction. But actually speaking, there are 100 transactions where there is some fraud. Those 100 are not selected as part of your sample for some reason. Then that is called as a sampling risk. What does it mean? The auditor is giving an opinion saying that everything is good, but there are some 100, like say, material misstatements are there, which the auditor is not able to detect because the sample is not pulling that. So that is a sampling risk. Sampling risk is the risk that the auditor's conclusion based on a sample may be different from the conclusion that the entire population was subjected to the same audit procedure. It simply means that the sample was not representative of the population. Sampling risk means sample is not representing the population. Actually, why we are selecting sample? To represent the population and do a testing. But that itself is not being properly taken care, means that is a sampling risk. What is other as non-sampling? Anything else other than the sampling risk. Maybe the auditor is not capable of finding or catching it, or the auditor is not aware, or the procedure is not right, a wrong procedure is used, wrong technique is used, or the tools used is giving a wrong result. So all those things are non-sampling risk. So detection risk may be reduced by, you're able to hear me?
Yes, sir.
Okay, detection risk may be reduced by increasing the area of checking, testing larger samples, and by including competent and experienced persons in the engagement team. Competent and experienced persons in the engagement team. Okay, so when you have a capable auditor, experienced auditor, then the detection risk may be low. That's what they're saying. Or if you are selecting only very few samples, increase the sample size, increase the testing, then the detection risk will be low. So what is not included in the audit risk? We already discussed this. The audit risk does not include the risk that the auditor might express an opinion that the financial statements are materially misstated when they are not. This risk is ordinarily insignificant because no auditor will give a report saying that if everything is wrong or there is some issue with the report when he doesn't have any kind of a basis to say that because material misstatement is not there. So it is very insignificant and it is not covered. Even if he is saying that the auditees will come back and counter argue and give the evidences to prove that the auditor is wrong. Even then the auditor is giving this report, then the auditor might not even take that report, they'll go for another auditor. Okay, so that is why this risk is not included. So the risk is that, so if the auditor is giving these kind of report, they might not even consider taking that report to their readers of the report, to the bankers, to the potential shareholders and other people, because they know that the auditor is giving a false report. So what we are looking at is not from the auditor's reputation. What we are looking at is from the users of the audit report, whether they are going to get impacted or not. They will not get impacted. That is why they are not considering this as a risk. Assessment of risk, a matter of professional judgment. So always we keep hearing the matter of professional judgment means what? Because the auditor is capable. He has studied so many topics. Like you guys are studying accounting, auditing, law, taxation, a lot of things. So the auditor has got good amount of knowledge about the subject. And the other side is that the auditor has done a lot of audits and he has varieties of business knowledge. And the same kind of clients he would have done multiple places. So, and also you would have done the understanding of the business with the client. So based on all these things, the auditor's knowledge is increased. Based on that professional knowledge, he is taking a judgment. Say, for example, in our case of car example, the 100 cars booked in inventory are booked in fixed assets. That is again a matter of professional judgment. Actually speaking, in both cases, the accountant can argue saying that as per IFRS only I have booked it as fixed asset, or as per IFRS only I have booked it as inventory. Both cases they can argue. Only when the auditor is having his own professional judgment, he has to judge it based on understanding the business and the accounting standards. Based on that, he has to take a call. Audit risk, what is included? See, as I told you, CID concept. This is what is ICD. CID. Okay. So ROMM is INC. And detection risk, again, they are breaking it down into S and NS. Sampling risk and non-sampling risk. So what is included in audit is that the opinion, inappropriate audit opinion when it is misstated. He is saying that everything is correct, but when something is wrong. A function of risk of material misstatement and detection risk. So material misstatement and detection risk. This is what is audit risk. But what is not audit risk? Auditor's business risk such as loss from litigation, adverse publicity, or other events arising in connection with the audit of financial statement. That is not the audit risk we are talking about. Auditor's risk, that is. That auditor he has done something wrong. Okay. So the auditor has given a wrong report or he hasn't catch a particular fraud. So all those things will lead to litigation and adverse publicity. That it is auditor's risk, not the auditor. We are not considering that here. This is the auditor might express an opinion that the financial statements are material misstated when they are not. So this is statements are right, auditor is giving that it is not right. That risk we are not covering. Okay. Now, combined assessment of risk of material misstatement. So this is what we already discussed, ROMM into D, which is ICD or CID. So we also discussed about this topic, inherent risk, control risk, and detection risk. When one is high, the other has to be low, then only the auditor can give a proper opinion. Identifying and assessing the risk of material misstatement. Identifying and assessing the ROMM through understanding the entity and its environment. As I told you in that example of cars, if the auditor doesn't understand the business of buying and selling cars, then he would say that it is okay to book the 100 cars in fixed assets, right? So that is where the issue will be. The auditor doesn't know the business, doesn't understand the entity and its environment, then he might come to a wrong conclusion. That is why understanding the entity is the important thing SA 315 is saying. Okay, so he has to assess, identify and assess the ROMM through the understanding of the entity and its environment. Means it's a tool for him to do it. So he has to understand the entity. So he'll say that I am going to come to your factory, show around the factory to me and the processes and how you do, what are the products you're having. So this is the understanding of the entity. While doing this, the auditor will be able to identify and assess the ROMM. Whether they are having strong controls, whether they are having weak controls, all those things the auditor will be able to assess. Okay, now coming down here, Auditor shall identify and assess the risk of material misstatement at the financial statement level, the assertion level for classes of transactions, account balances, and disclosures to provide a basis for designing and performing further audit procedures. This we already seen at the financial statement level or at the assertion level. Identify the risk throughout the process for obtaining and understanding the entity and its environment, including relevant controls, considering the class of transaction, balances, disclosures, etc. Throughout the process, obtain understanding of the entity, environment, control, risk, class of transaction, everything the auditor will have to go through. Then only he will be able to identify the risk. After identifying the risk, what he has to do? He has to assess the risk. Okay, whether they relate more pervasively as a whole and potentially affect many assertions. See, this is the important terminologies you need to write. See, as an audit student, you keep on writing all the jargons in a separate notebook, say a 40-page notebook. Why a lot of students fail in audit is primarily because they don't write the audit jargons and terminologies correctly. Instead of saying material misstatement, you will say that significant misstatement or you will say big misstatement. Then your marks are gone. So materiality, performance materiality, overall materiality, and then if you look at it here now, pervasively is a audit terminology. What do you mean by pervasively? It is cutting across. Means it is not at one place, it is not small. Throughout it is there. That is what is pervasively. If you draw a ruled node, from top to bottom you put a cross, then that cross is actually cutting every line at different places and this is across the page overall. So that is what is pervasively. Let me connect my charger. Give me a moment. So the point here is that the risk is pervasive. Then it is going to be a high risk. If the risk is not pervasive, then it can be rated as medium risk or low risk. That is how the auditor is assessing the risk based on its pervasiveness. Relate the identified risk to what can go wrong at the assertion level, taking account of relevant controls the auditor intended to test. Relate the identified risk. What can go wrong at the assertion level? What is going to go wrong? See, what is the risk? What can go wrong? See, in inventory, what can go wrong? Somebody can steal the inventory. Or the inventory is 50,000, but we are reporting as 40,000. That is the risk valuation, right? Like these are all the what can go wrong if you keep asking, then only you'll be able to understand what are all the risks in that particular area. Then you need to consider the likelihood of misstatement, including the possibility of multiple misstatements. So what is the likelihood that the asset, the inventory is being stolen? It cannot be stolen every day because we are having strong controls here, this and that, CCTV camera, security and all that. But still there is a possibility that once in a year when the company is on leave, these things are not working or there is a power shutdown, people can run away without being noticed. So that is the risk we are considering. That is the likelihood, whether it is once in a year or once in a month or once in 5 years or once in 3 years, that is what is the likelihood of the risk. Say for example, if you say that the risk that our factory might be damaged due to a cyclone, what is the possibility of cyclone in Chennai? Every year we'll get one cyclone or multiple cyclone and one cyclone might be a severe cyclone. Then it is a high risk. But for a place which is very less impacted by cyclones, they'll say that it is a low risk, right? Say floods, Chennai, it can be a high risk because every flood 2-3 days or any operations are getting started. It can be a high risk. But if you look at like in the last 3 years or 5 years, then it. Are you able to hear me?
So your voice is breaking.
Is it better now?
It's better now.
Okay. It's better now, right?
Yes, sir.
Okay. So now, for a particular location where the risk of cyclone is very minimal, then they can call it as a low risk. So the frequency will, the frequency or the likelihood is the frequency which we are talking about. Likelihood, impact, all those things will The auditor will consider to assess the risk as low, medium, high. What are the two things he will consider? Likelihood and the impact. Likelihood is high and the impact is high, then it's a high risk. What is an impact? What is the damage I'm going to get because of the cyclone? 5 crore or 50 crore or 500 crore or 5,000. So that is what is the impact. Because all my equipment will be gone underwater or it will be broken, then it's a big impact. So I'll put a value for that. Then I'll find out what is the impact. So these are the things which the auditor will have to consider as per SA 315 for identifying and assessing the ROMM. First, he is identifying the risk, and then he is assessing the risk, and then he is like say what can go wrong at the assertion level. He needs to look at and then rate the risk based on the likelihood. So now risk assessment procedures. The audit procedures performed to obtain an understanding of the entity and its environment, including its entity's internal control, to identify and assess the risk of ROMM, whether due to fraud or error, at the financial statement and assertion level are defined as the risk assessment procedures. So the procedures performed by the auditor to see whether the entity and its environment, internal controls, identify and assess the risk of material misstatement due to fraud or error are defined as the risk assessment procedures. What is included? Enquiries to the management. How will he do that? He will go ahead and talk to the management, CEO, CFO, directors, and other people. He'll do analytical procedures. Means what? He'll do his own computation, check what is the percentage, what is the gross profit ratio for a similar company in the market as a competitor. What is for this company? Why this is going up? Why this is coming down? So like that, he's doing some analytical procedures, ratios, trends, comparison between last year, this year. Those are all analytical procedures. And then observation and inspection. He is going on a physical visit for the company in the factory and he is observing things, and that's actually a observation and inspection. And enquiries of the management and others within the entity is going and talking to people who are working in the company and checking what can go wrong. These are all the procedures he does to get these, three procedures. What are the three procedures? Enquiries of the management, analytical procedures, and observation and inspection. So now enquiries of the management, what does he do? He goes and schedules meetings and talks to different people and get different perspectives. Okay, so these are all inquiries directed towards internal audit personnel and provide information about the internal audit procedures. And inquiries of employees involved in initiating, processing, or recording complex transactions. In-house legal team, marketing sales personnel, risk management function, information system performance, like personnel. So for each team, he will ask different set of questions to understand overall what are all things happening in the company, what is the risk. What is the analytical procedures here? As I told you, ratios, trend analysis, comparisons between last year, current year, all those things are the unusual or unexpected relationship that are identified, may assist the auditor in identifying risk of material misstatement. In such analytical procedure, use the data aggregated at a high level. About whether a material misstatement may exist. Accordingly, in such cases, consideration of other information that has been gathered. Okay, next one, observation and inspection. He is going through, walking, talking to people, he observes, he inspects things. So through entities operation, through documents, reports prepared by management and entities premises and plant facilities. Information obtained by performing risk assessment procedures used as audit evidence. Okay. So the auditor is performing risk assessment procedures and he's collecting some documents, he's asking for some reports, he's reviewing that. That can also be used as an audit evidence to form the opinion or form the risk assessment rating for that particular business or that particular unit. Even though such procedure were not specifically planned as a substantive procedures or as a test of control, the auditor may choose to perform substantive procedure or test of controls concurrently with the risk assessment procedures because it is efficient to do so. What are they saying? Don't do the risk assessment separate and test of controls and test of details separately. If you want to do it, combine it together, do it at the same stage itself and combine risk assessment procedure along with the test of controls or test of details. Materiality. What is meant by materiality? See, planning the audit and performing the audit. There are two materialities. Okay, what are they saying here? Misstatements, including omission, are considered to be material if they individually or in aggregate would reasonably be expected to influence the economic decisions of the users taken on the basis. What is the economic decision? As an individual, you are deciding whether to invest in Tata Motors or not. That is an economic decision. And if the report is wrong, say their gross profit ratio, they are showing it as 32%, but actually there is some errors or there is some issues with that. And you are able to see only at 28% or 25% is the actual gross profit ratio. But they are reported it as 32%. Because it is 32%, you compare it with the competitors and you are planning to buy their shares or invest heavily in that shares. Now, this is influencing the decision, economic decisions of the users. And now the 25% to 32%, 7%, that is a material number for them, for that particular company. So that is what we are looking at as materiality. See, instead of 2000 crore, you put 2000 crore and 1,52,000 and 2000 crores and 1,53,000. It is not material, 1000 rupees, because it's a 2000 crore company. Nobody will think about it. It might be even rounded off. Nobody will get to know even 1 lakh, 10 lakh also if it is a 2000 crore company. So that is where the materiality is. If for each company, each books, each line item, it might differ. So the objective of an independent auditor is to obtain reasonable assurance about whether the financial statement as a whole are free from material misstatement, whether due to fraud or error. These things are all basically you need to write it down and mug it up. Okay. So whether due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statements are prepared in all material aspects in accordance with an applicable financial reporting framework. So the objective of an independent internal auditor is to obtain assurance about the statements are free from errors, free from material misstatement, either due to error or fraud, and thereby enabling him to express an opinion whether the financial statements are prepared in all material respects. Herein lies the significance of materiality. Auditor has to obtain reasonable assurance that the financial statements as a whole are free from material misstatement, whether due to fraud or error. As a result, an audit strives to identify significant risk of material misstatement and audit procedures are geared towards it. So audit has to obtain reasonable assurance. This is also an important term, underline and note it down. Reasonable assurance. What is reasonable? Somebody might say 80% is reasonable, somebody might say 90% is reasonable, depending upon the circumstances and situation. Somebody might say 99% is only reasonable. Right? It all depends upon situation and circumstance. Reasonable means what? Okay, at the high level it looks good. Right? So that is what is reasonable assurance. As a normal common man who is having sufficient professional knowledge about this area will also arrive at the same conclusion, because it is reasonable assurance. Materiality is not always a matter of relative size. Okay, we said the 2000 crore 1 lakh, we are relating it. Okay, but what they are saying, it is not always a matter of size. A small amount lost by fraudulent practices of certain employees can indicate a serious flaw in the internal control system, requiring immediate attention. See, it can be only 50,000 rupees fraud, but it has a potential that if the same fraud is continuing, it can go to crores, and it is impacting the company's reputation, company's morale of the employees, and a lot of different things are there. So not only go by the quantity, go by the quality also is what they are saying. Materiality in planning and performing an audit. Auditor's responsibility. Concept of materiality is applied by the auditor in both planning and performing the audit, and in evaluating the effect of identified misstatements on the audit and of uncorrected misstatements, if any. SA 320 deals with the auditor's responsibility. What is that they're saying? Although financial reporting frameworks may discuss materiality in different terms, they generally explain that Misstatements including omissions considered to be material if they individually or in aggregate influence the economic decision, which we already seen. Judgments in the light of surrounding circumstances, size or nature of the misstatement or combination that are material to users are based on consideration of common financial information needs of users as a group. Possible effect of misstatements on specific individual users whose needs may vary widely and is not considered. So what are the different groups of users they are talking about? We see the shareholders, potential shareholders, investors, bankers. These are all the group of people, and even maybe the government authorities, SEBI, and then say tax authorities. Say specific group of users, say tax authorities. They are more concerned about whether your tax reporting is correct or wrong. Say in Caro, while doing your audit reporting, you need to submit, like say, 20 plus different points. The auditor will have to comment, oh, there is no more than 45 days MSME loan given, or like say MSME's related payments are outstanding, and this is not done. Audit trail is there, and this and that, everything you're writing, right? So for each and every individual user, you are considering them. So this will also become material. That is why they are coming out as a separate item in the audit report. So each group of users is asking what, based on that you need to consider the materiality. Determining the NET, nature, extent and timing. Identifying and assessing the risk of material misstatement. Determining the nature, extent and timing of further audit procedures. So this NET is for risk assessment procedures. This is for further audit procedures. In between, you are assessing the ROMM. So auditor's responsibility is that first he has to see what are all the areas, judgments, and then about specific users, and then he has to do NET, and then assess the ROMM, and then further NET for further audit procedures. Although it is not practical to design audit procedures to detect misstatement that could be material solely because of their nature, the auditor considers not only the size but also the nature of uncorrected misstatement and particular circumstances of their occurrence when evaluating their effects on the financial statements. So what are they saying? So not only it is not possible to detect every misstatement. So you should not only consider the size but also the nature of uncorrected misstatements. See, the auditor has identified some 20 misstatements, out of which 15 are corrected, but 5 are not corrected. Those 5 are material or not, he has to consider. And he also has to consider if there are something which is unidentified also, which is not identified by the auditor. So overall, based on that, he will form a judgment saying that, yes, this is material and I have to report it. It's a matter of professional judgment. So who can do that? Who has a reasonable knowledge of the business and economic activities, who understand the financial statements, who recognize the uncertainties inherent in the, which is inherent risk, and then make reasonable economic decision on the basis of the financial information in the financial statements. What is the performance materiality? Say the auditor is fixing 2 crore as a materiality. What will he say? 2 crores is a materiality. Anything crossing 2 crore will have to report it. See, you are all part of the audit team. 5 auditors are assigned. Each auditor is given saying that if it is crossing 2 crore, let me know, we need to report it. So each junior auditor is assigned one for inventory, one for fixed assets, one for revenue, one for purchases. Okay, like that each person is going and doing an audit. When there is a misstatement, they are saying that, okay, only 90 lakhs misstatement, only 50 lakhs misstatement. They are not bothered to correct it. They are not insisting on the management to correct it. They are saying it's immaterial, leave it. At the end of the day, the auditor is reviewing. Each auditor is saying 50 lakhs, 90 lakhs. Aggregated, now it is coming to 2.5 crores. Now the auditor will have to report it. Right? Because 2.5 crores of misstatement the auditor has found. 2 crores is the materiality threshold. So now the auditor will have to report it. So to avoid that, what the auditor does is that for each line item, there will be a performance materiality set at the individual level. Say for income tax, anything more than 5,000 will have to report it, or anything more than 1,000 will have to report it. For let's say MSME related payments, anything more than 45 days which is even a single rupee we need to report it, because all these things people are looking at. And for inventory, instead of 2 crore, let's put it as 50 lakhs. For fixed assets, 50 lakhs. So that now everybody is coming up with 30 lakhs, 50 lakhs. Overall, if you put the number also in total, the materiality will not cross the overall materiality. That is the purpose of putting a performance materiality. See, it is difficult for auditors to design tests to identify individual material misstatements. It is likely that the misstatements are material in aggregate. It takes us to the concept of performance materiality. At a less than materiality for the financial statements as a whole, to reduce to an appropriately low level the probability that when aggregated of that the aggregate of uncorrected and undetected. See, uncorrected is something you detected but they are not correcting. Undetected is something you think that something you might not detect. So there is a possibility that I detected 5 crore errors, but there can be another 2 crore error also. So undetected misstatements exceeds the materiality for the financial misstatement, for the financial statement as a whole. If applicable, performance materiality also refers to the amount or amounts set by the auditor at less than the materiality level or levels for particular classes of transactions, balances, or disclosures. Performance materiality is set at a lower level, value lower than the overall materiality. It lowers the risk that the auditor will not be able to identify misstatements that are material when added together. So determining materiality and performance materiality when performing the audit. One or more particular class of transactions, account balances, misstatements of lesser amounts than the materiality as a whole would be reasonably expected to influence the decision of the user. Say for example, overall 1 crore, 2 crore, the people are okay with materiality limit. But for a particular line item for say taxation, they are not willing to see that 50 lakhs tax is wrong, the number is wrong. So that tax and all, they wanted to be like say compliance specific. Even if it is a shareholder or a potential investor, they wanted to make sure that there is no compliance issues. So even for taxes, they say that anything more than 50,000 or 1 lakh is an issue. So that is why they are fixing it at a lower number. Use of benchmarks in determining materiality. A percentage is often applied to a chosen benchmark as a starting point. See, what is the percentage for this particular line item? Like say 2%. Sales means okay, 2% of sales. Purchase means 2% of purchase. And maybe for expenses, you are putting it as 5%. So like that, you can put a percentage materiality or you can put a whole number materiality also. Consider, for example, when as a starting point, a materiality for the financial statement is determined for a particular entity based on a percentage of profit before tax. Circumstances that give rise to an exceptional decrease or increase in such profit may lead the auditor to conclude that materiality as a whole is more appropriately determined using a normalized profit before tax from continuing operations figure based on past results. So they are giving a percentage based on the profit before tax. But the profit before tax itself is changing depending upon the number of issues identified by the auditor. Auditor may consider 5% of PBT, okay, in a manufacturing entity, while the auditor may consider 1% of total revenue or expenses for a not-for-profit entity. For different circumstances, different benchmarks or targets the auditor can keep. Materiality level. Factors that may indicate that the existence of one or more particular class of transactions, account balance, or disclosures. Law, regulation, or the applicable financial reporting framework affects the user's expectations regarding the measurement or disclosure in the related party transactions. remuneration to management charges governance, the key disclosures for R&D for a pharmaceutical company. Attention is focused on particular aspects of an entity business, newly acquired business. So like that, materiality level can differ for different transactions or account balances. So can the auditor revise the materiality after he had set it? Yes, he can revise it because he had set the materiality based on a particular assumption. If the assumption is changing as the auditor is progressing in the audit, say profit before tax, but the profit before taxes keep on changing because the auditor has found a lot of errors and issues and the profit is adjusted. Now again, the auditor can revise the materiality level. He might even fix it at even further low level, saying that there are too many errors or frauds in this company, so I don't want to fix it at 2%, I want to fix it at 1%. It can also happen. That is what they're saying here. He can change it. Documenting the materiality. Audit documentation shall include the following amounts and the factors considered in their determination. Materiality of the financial statement as a whole. C, you can see performance materiality. B is, if applicable, materiality level or levels of particular classes of transaction balances or disclosures. Okay, for specific items, what is the materiality? Any revision of A to C as the audit progressed. All these things has to be documented and kept in the audit documentation files. Materiality and audit risk are considered throughout the audit, in particular when identifying and assessing ROMM, determining the nature, extent and timing of further audit procedures, evaluating the effect of uncorrected misstatements. Okay, with this we'll take a short break and then we'll reconvene. Okay, welcome back. So we are on our third chapter, risk assessment and internal control. Subtopic 1 and 2 are covered. Now we are on topic number 3, understanding the entity and its environment. The auditor shall obtain an understanding of the following. What are the following? What is the industry? What is the regulatory requirement, whether it is IRDA or RBI, or what is the regulatory requirement? And what is the other external factors impacting the financial reporting framework? Like say it can be some seasonal activities of the product, or it can be oil and mining, and they might have to report a specific accounting standard. So all those things you need to consider. What is the nature of the entity, its operations? What are they? Is it very unique operation, or whether they are having competitors? What is the ownership? What is the government structure? What is the investment? Whether they are getting all bootstrapped, or whether some investors are there into the company, internal investor or foreign investors, whether forex is being involved. So all those things you need to understand. And whether bank loans are there, which are all the banks which has given them loans, how is the structure being operated, whether it is 10 different companies are investing in this company, or is it like say people are investing in this company, or complex structure or simple structure. The entity selection and application of accounting policies, whether they are doing Ind AS or IFRS or any other GAAP or US GAAP. So why they have selected, whether it is right for this company, for this industry, and the entity's objectives and strategies, and those that related to business risk that may result in risk of material misstatement. What is the company's objectives, strategies? Like say, for example, if they are a biryani restaurant, they wanted to open 500 branches in the next 1 year. So that is an objective, that is a strategy. For that strategy, what is the risk? They're going to open up more and more branches. So are they properly looking at a landlord related agreement, and whether it is going on a franchisee model, whether they are bringing in new people, whether the quality is going to be at risk, and what are all the, in terms of financial statement, what is the risk which is going to impact? All those things we need to look at it. Business risk, which is relating to the misstatement. The measurement and review of the entity's financial performance. The measurement and review of the entity's financial performance. So what is the financial performance, how they are doing compared to the peers, compared to the last year, last period. So all those things you are going to measure. These are all is what related to the understanding of the entity and its environment. Why is it significant? As I told you, if you don't understand the entity, the accounting itself can vary, whether fixed assets or inventory. It all depends upon the business. Understanding the entity is a continuous process. It is not that I'll understand the entity before I go and start the audit. Even while doing the audit, you keep on adding your knowledge about the entity and understanding of the entity. Because everything you cannot do it before you start the audit. As you progress also, there are a lot of things which will unfold, which is new to the auditor. So you need to keep adding them. What is an internal control? With that, we are moving to topic number 4 or subtopic 4, internal control. Process. So internal control is a process designed, implemented and maintained by TCWG, those charged with governance, management and other personnel to provide reasonable assurance about the achievement of an entity's objective with regards to the reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets and compliance with applicable laws and regulations. So what are all the things which is going to internal control is going to help? It's a process. It's implemented and maintained by TCWG, those charged with governance, maybe the board of directors in simple terms for a company. TCWG, management and other personnel. Why they are saying other personnel? Sometimes the consultant may also be interested in the implementing the internal control. To provide reasonable assurance. It's not absolute assurance, it's always reasonable assurance about the achievement of entity's objectives. Why we are putting control? The entity has to achieve the objective of 500 biryani shop in that example. With regard to reliability of financial reporting. So reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets and compliance with laws and regulations. So these are all the 4 important things the internal control is addressing. Okay, so you can see this here. Reliability of financial reporting, effectiveness and efficiency of operation, compliance with applicable laws and regulations, safeguarding of assets. If you want to put a small acronym, you can put it as SCARE. S, safeguarding of assets. C, compliance. CA, compliance with applicable laws and regulations. CA. R, reliability of financial reporting. E, effectiveness and efficiency of operations. So SCARE, internal control is actually a SCARE for people. You know, for operations people, it is a SCARE. So that is what is internal control. SCARE, safeguarding of assets, compliance with applicable laws and regulations. R for reliability of entities' internal financial reporting, and E is for effectiveness and efficiency of operations. Once the auditor is understanding the internal control, he'll be able to identify the potential misstatements, types of misstatements, and factors that affects the ROMM, and he will be able to design the NET of further audit procedures. These are all the benefits of understanding the internal control. What are the limitations of internal control? Internal control can provide only reasonable assurance, no absolute assurance. That's why it's a limitation. Human judgment is there in processing this. So there is always a human judgment when there is an internal control. Means what? Say for example, the security guard is there in the housing society. He is being given a job that saying that anybody new to the apartment, you need to ask them to sign the visitors register. So he is stopping anybody new. And there is somebody who is coming into the building. He's saying that I am there staying in that flat, you don't know me, and then he is leaving in. But actually this person is not staying in. So this is actually a human judgment. The security is thinking that, okay, that guy is belonging to a flat and he is a resident and he is allowing him in. So it's a human judgment, but actually if you see that, it's an error, right? So human judgments can be faulty. So there is the internal control may not be 100% accurate. That's what they're saying. Lack of understanding the purpose. If the security doesn't even understand the purpose of why that visitor register has to be signed, he might not even ask them to fill all the columns. Date, time, name, phone number, all those things. Phone number is not there, he will also leave it. But why they are writing all these things? In case some mishappenings had happened or something is being stolen or that person has not come out of the apartment, then they will be able to call them, or he has parked his bike and it is obtruding, let's say obstructing someone else. Then he can call that number and ask him to get that bike removed. So for all those purposes has to be explained to the security, then only he'll operate the internal control properly. Collusion among people. So there are two security guys there, and there is one guy who is a thief who wants to enter into the society. He pays a few rupees as bribe to both the securities. So now all three people are colluding, so that guy enters into and does whatever he wanted to do. Judgments by the management. There is a lot of judgments taken by the management. So because of that, what happens is that sometimes the management judgment may be not right. See, in designing and implementing control, management may make judgments on the nature and extent of the control it chooses to implement, and the nature and extent of the risk it chooses to assume. See, management might say that, hey, there is no big risk of inventory theft, so I don't want to put CCTV controls. But actually, there might be a significant risk there. The management is not aware, or the management is taking huge risk. So management judgment is involved there while implementing the controls. Limitation in case of small entities. See, a lot of times the main control what is put is actually the segregation of duties. Means one person should not be entrusted with all the tasks of a particular transaction. Say for example, cash collected in college. Cashier will be there, separate accountant will be there, and separate person will be there going to the bank and depositing the cash. So, and like say accountant will be posting the entry, and at the end of the month, another person will review and reconcile it. So 3-4 people will be involved in the same process. So if one does an error or a fraud, the other one will be able to catch it. That's the logic. But what happens in a small entity, you don't have 4 people to do the same small task. So they'll say that one person will be interested in doing all these things. But what will happen? The control is lost. But how it will be compensated? The owner, he himself might do all these things. So obviously he himself is not willing to do a fraud to his own company. Or somebody else is doing and the owner will monitor him regularly. Or he knows him personally and he keeps checking it. So there will be some kind of a compensating control. Sometimes they're saying that the owner might also be intended to do fraud, so he will also override the controls in a smaller company. That is also possible. That's what they're saying here. So these are all the limitations of internal control. Even though you have internal control, that doesn't mean that there is no error or fraud, because it is only providing reasonable assurance and there is a huge human judgment involved and lack of understanding the purpose, collusion among the people, and collusion among people and judgment by management and limitation in case of small entities. So because of all these things, there is some limitation for internal control. See, the COSO framework provides the components of internal control. COSO is basically the American organization, Committee of Sponsoring Organization. They provide a framework called as COSO framework. In that, what are the 5 components of internal control? There should be a proper internal control environment, and there should be monitoring of controls. These are all the supporting elements, the main elements of entities risk assessment process, and then the information systems and control activities. So this is basically defined as CRIME as an acronym. C stands for control activity, R stands for risk assessment, I stands for information system and communication, M stands for monitoring of controls, and E stands for environment, which is control environment. So these are the 5 elements of or components of internal control. CRIME, CRIME. What is a control environment? See, some companies might be very strong in terms of implementing the control because the management is very strict. They say that every day people have to be in office at 10 o'clock. They can leave only after 7 o'clock. If there is anybody who is violating this, then For every minute they are late, there will be some deduction in salary. In the control environment related to human resources is strong. And there might be some companies which will say that, hey, anytime you come into the office, anytime you can leave the office. Only thing is that you need to get the job done. The work has to be done properly. So in this case, the HR controls might be operating, but it is in a different way. Okay, but there can be some other company, they don't even bother about the work being done. They don't even control the employees or the timings and other things. So it all depends upon different companies and the way they are putting their control and way they are operating. Say another example of formals only in one company. Another company saying you can come in casual, you can come in t-shirt, you can come in shorts also. Because we are a creative company and we need to create a lot of things. So a mundane kind of a formal dressing is not good for us. So these are all, part of the culture of the company. So based on the culture, the control environment is being formed. See how it is being formed. Management has created and maintained a culture of honesty and ethical behavior. See, for control environment to operate good, you need to have a honest culture and an ethical culture. The strengths in the control environment elements collectively provides an appropriate foundation for the other components of internal control. What is included in the control environment? Governance and management functions, attitude, awareness, and actions of TCWG. The control environment sets the tone of an organization, influencing the control consciousness of its people. See, we know governance and management function, the top level people, TCWG, senior management. The attitude, the awareness and actions of TCWG. See, if TCWG is taking stringent action on people who are involved in fraud, then other people will be worried about fraud and they will be reporting fraud and they will not be even thinking about doing fraud. So that will be a strong control environment because that is coming from the action taken by TCWG. The control environment only sets the tone of an organization, of the control consciousness of its people. Some company will say that the CEO will say that any income tax filing, GST filing has to be done 2 days before the deadline. Then everybody will be working towards that. So tone of the organization. Some company will say that first work on the business, let's get the sales, then we'll worry about all the compliances. So that is another company, another different set of company where their control environment is weak. Communication and enforcement of integrity and ethical values. See, integrity and ethics is the foundation on which the company is operating. The control environment is operating. If the integrity and honesty and ethics is not there, then whatever controls you put in, it might not be able to operate as intended. You say that if somebody has to enter the office, they should either have an ID card or they should use a visitor register. And the security is taking bribe and allowing people inside the company without doing either of them. Because of integrity and ethics, the control environment is bad and it is lost. Commitment to competence. Why they are saying competence? Say, for example, one company is a owner-driven company is putting all his relatives in the top management post. They don't even know what is finance. That person is the finance manager or the CFO. Now, because of this person being incompetent, when the finance manager is going and talking to the CFO, saying that this is how we need to do, the CFO doesn't understand and he doesn't give proper attention to it, then it might lead to serious repercussions. Participation by TCWG. The more the TCWG is involved in the company, asking questions and scrutinizing, then the company will be having a good control environment. What is the philosophy of management and how is their operating style? Like say management's attitudes towards financial reporting. They say that we don't accept any kind of fraud. Then it's the right philosophy. If they say that for me sales is the only target, make sure that from last year's sales we should be 3 times this year. This is the only thing they are talking about, means people will be only working towards sale. If they are not able to make the sale, they will cook the books or they'll do a fake sale. So all those things can happen. So management should have their philosophy of control consciousness and control mindset. Organizational structure. See, this person has to report to this person has to report to this person. If not, they will ask questions. So these are all the organizational structure. There has to be a proper structure depending upon the size of the company. Then only they'll know that if I don't do this work, then I'll get a call from my manager or I'll get some questions from people. Then only people will start working on it properly. Assignment of authority and responsibility. How reporting relationships and authorization hierarchies are established. See, some persons can be given authority, at the same time responsibility should also be given to them. HR policies and practices. Let's say entering into the office at this time and training to people, recruitment policies, procedures, all these things will define the basis for the entities risk assessment process. First, identify the business risk related to the financial reporting, then estimate the significance, likelihood, then deciding about the action to address those risks. As I told you earlier, impact and likelihood. The impact is what they are given it as significance of the risk. Then decide what you should do to address this risk. This is what is called as entities risk assessment process. The information system. So what are all the IT related systems are there in the process? What are the emails and how the intranet is being used, how people are communicating with each other through WhatsApp or through email, and what kind of transparency is there in the communication, who are all there. So all those things are required. You need to see what is the class of transactions that are significant, procedures by which those transactions are initiated, corrected, recorded, processed, the related accounting records, how the information system captures those events. Whether, see, if you look at it in a supermarket, there are two ways or multiple ways to do the billing of that particular sale. One way is that people will go put the items in the tray, automatically based on the barcode, system will generate the invoice and people will do a card swipe, they can take it out. Completely automated. Or there can be a manual scanning of it by counter. That is second way. Third way is that person will look at the product and then he'll type the code and he'll do the billing. And then the fourth way is that there is no computer system at all. People are looking at it and writing a bill in a sheet of paper. So the risk involved in each one will differ because of the information system. In one it is manual, other it is computer generated, third one it is automated with barcode scanning with manual intervention. Fifth, last one is fully automated without any manual intervention. There can be risk for each one depending upon their information system, what they are using. Controls surrounding journal entries, what are the IT system being used, what is the policy manuals, what is the control activity. Control activity, it is the auditor considers necessary to assess the risk of material misstatement. So an audit requires an understanding of only those control activities related to significant class of transactions, account balance, and disclosure in the financial statement. Control activities relevant to audit generally include policies and procedures relating to performance reviews, information processing, physical controls, SOD. So all these things are control activities. Physical control means physically somebody entering into the office, there is a control there. Information processing controls, basically like people entering into the computer system, they'll have to do a login ID, password, and arithmetical accuracy, there will be automatic checking by the system. So those are all information processing controls. SOD controls, segregation of duties. As I told you earlier, one person receives the cash, other person counts it and puts it in the box, third person goes to the bank, fourth person do the journal entry, fifth person doing the reconciliation, like that. Multiple ways it is being segregated. That is the segregation of duties. Monitoring of controls. How do you monitor the controls? Whether the controls are operating. See, if you look at it, any control, it will not operate on its own unless and until it is being monitored. Say the example of roads in India, there are traffic lights, still people won't follow unless and until they see a man with a white shirt, the traffic cop. Only when they see the police guy, they'll stop for the red signal. If they're not seeing the police guy, they are skipping and going. Now we cannot police guy in every place. So now the government has become more automated. They are saying that we will put a CCTV camera. Whoever is crossing or jumping the signal will automatically send a report to them. So now government is monitoring the existing control. That is why the controls are working. So monitoring is a very, very important aspect. If it is not monitored, control may not work. For all controls relevant to an audit. Not every control is relevant. It all depends upon the materiality, the significance of the risk, size of the entity, diversity, complexity. So it depends upon that the auditor will select which controls to be tested for the audit. Controls over the completeness and accuracy of the information. What is the completeness? Is receiving an information, whether it is complete, whether it is accurate, he has to assess. That's what they are saying here. Internal control of the assets, they'll have CCTV camera, they will have security guy. So there will be some internal controls for that. So the auditor might have to assess them as well. Controls relating to objectives that are not relevant to an audit. So they'll have 100 different objectives for the company. Is it necessary to do everything as an audit? Not required. If it is not relevant to the audit, the auditor might skip that. Although the internal control applies to the entire entity or to one of its operating units or business process, internal control relating to each of the operating units and business process may not be relevant to the audit. In circumstances, the statute or the regulation governing the entity may require the auditor to report on compliance with certain specific aspects of the internal control. As a result, review of internal control may be broader and more detailed. So some places the controls are too wide, the auditor might focus on what he wants. In some places the controls are too narrow, the auditor wants to cover more area, depending upon the statutory requirement. Even though there is no internal control, the auditor will be focusing on further more areas. That's what they're saying, both ways are possible. Nature and extent of understanding of relevant controls. Inquiry of entity personnel, observing the application of specific controls, inspecting the documents, tracing the transactions. Say the auditor is asking, how will you report a particular purchase? They'll say that we'll place a purchase order. Based on the purchase order, the supplier will send the goods. Then our security guy will check the number of trucks entering in, and he'll issue a GRN, goods receipt note, based on the number of items he counted, and then it will come to the receiving team. They'll count it one by one. They'll again sign off the GRN and say that this is what is received. Then they'll send it to people, and then it will be posted into the inventory system, whether the controls are being implemented. So in that case also, the auditor will have to go through it by inquiring the personnel, observing what is happening, inspecting the document, and tracing the transactions. What are the risks that require special audit consideration? First thing and foremost is the fraud risk. If there is some fraud risk, the auditor has to consider it special consideration. Whether it is related to significant economic accounting or other developments in the regulatory environment, therefore requires special attention. The complexity of the transactions. Whether the risk involves significant transactions with related parties. Related party transactions are always high risk because that is historically we are seeing that huge number of frauds are happening there. Since it is related party, nobody bothers too much about it. It is all within the company. But the auditor has to bother because there only the fraud related activities are happening. Whether the risk involves significant transactions with related parties. Degree of subjectivity in the measurement of financial information. Degree of subjectivity in the measurement of financial information related to the risk, especially those measurements involving a wide range of measurement uncertainty. See, you need to measure inventory, 1 crore or 2 crore. You need to measure the value of the asset. So a lot of things you need to do some measurements, those areas the auditor will have to be giving more consideration to do the audit. Whether the risk involves significant transactions that are outside the normal course of business for the entity, or that otherwise appears to be unusual. Identifying significant risk. ROMM due to fraud and significant transactions with related parties that are outside the normal course of business. What are they saying? See, I'll be taking certain examples as hypothetical examples. Like earlier, I've taken Tata Motors or Reliance and stuff like that. It's for bigger groups. Say Tata Motors is selling 100 cars to their aircraft carrier. What is that now? Air India, okay, or Vistara or whatever. So now they are selling 100 cars to their flight company. So it is a normal course of the business to car company to sell car and flight company to buy car. So it's a normal course of business. If it is at the arm's length, then it is all good. But if it is an abnormal transaction, like they are giving 50 crore or 100 crore as loan from this company to that company, then that has to be, if the value is significant, the auditor will have to look at it from a risk point of view. Risk of material misstatement, greater for significant non-routine transactions. Greater management intervention to specify the accounting treatment. Greater manual intervention for data collection, processing, complex calculations. Nature of non-routine transactions. See, if it is a routine transaction, it's okay. If it's a non-routine transaction, there might be a significant risk. And if it is a material transaction. So that is what they are looking at it more closely. If more management is intervening in an accounting treatment, and if there is more manual intervention in data collecting and processing, and there are complex calculations, and it is non-routine transaction, then these are all the areas auditor will have to look at it. Accounting principles for accounting estimates or revenue recognition may be subject to differing interpretation. As I told you, one person may conclude that 100 cars to be booked as inventory, other person might be convinced that it has to be booked as fixed assets. So these kind of areas where it is a gray matter in terms of applying the accounting principle, the auditor has to put significant attention. Right? Required judgment may be subjective or complex, or require assumptions about the effects of future events. For example, judgment about unfair value, or judgment about fair value. See, it's a fair value is a judgment. Okay, whether I can sell it for 5 crore or 10 crore or 2 crore. So all those areas where judgment is required, that is also to be looked at. Auditor needs reasonable assurance that the accounting system is adequate and that all the accounting information for which should be recorded. See, now we have completed topic number 5. We are getting into evaluation of internal control system. The auditor has to evaluate the internal control system and the benefits of the evaluation. Internal control system is there, the auditor is evaluating it, then he will know whether the errors and frauds are likely to be located or not in the ordinary course of business. Whether an adequate system is in use or not. Whether internal auditing department is operating or not. Whether any administrative control has a bearing on his work. Okay, administrative control. If the control over worker recruitment and enrollment is weak, there is a likelihood of dummy names. Okay, so false employees or ghost employees can be added to the system. So those and all he has to assess it while he is assessing the internal control system. Whether the controls adequately safeguard the assets. How far and how adequately the management is discharging its function. How reliable the reports are and certificates to the management can be. The extent and depth of the examination he needs to carry out in different areas of accounting. If the control is strong, then he will do at a high level. If the control is weak, he has to do depth. What would be appropriate audit technique in this particular case? What are the areas where the control is weak? Whether some worthwhile suggestions can be given. All those things it will be He'll be able to conclude depending upon the understanding of the business and the control environment. Okay. Now moving forward, evaluation of internal control method. The four types which you are going to assess here is narrative records, checklist, internal control questionnaire, and flowchart. What is a narrative? It's basically a written document full of wording saying that this is what is this is what. How do we do a purchase order? So we receive the inputs from the business teams. Based on that, we'll create a purchase order. Okay, so that is a narrative. What is a checklist? So it's going through the narrative record. So it is an exhaustive description of the system as found in the operation by the auditor. Why it is being read? To comprehend the system in an operation is quite difficult. To identify the weaknesses or gap in the system. Okay, so these are all the disadvantages of a narrative record because it's a voluminous documented thing. It is not easy to identify the gaps or weakness by reading through 20-page document. It is to incorporate changes arising on account of reshuffling of manpower. So these are the negative, like say, disadvantages of narrative record. So now checklist comes into picture. So the audit staff has to follow the checklist by saying yes, no, or not applicable. Okay. Have you interviewed the personnel in this team? Yes. Have you interviewed their manager? Yes. Did they report that they have completed their internal audit procedures? Yes. Is there any significant issues? No. Like that, you can give yes or no kind of a checklist. So that will make sure that the auditor is going through all the requirements for a particular audit. Standard checklist. Internal control questionnaire. Generally, yes and no questions should be given, the answers. If answer is given as no, then they will have to expect an explanation. Internal control questionnaire will be prepared, say for example like this. This will be sent, say for example 100 biryani shops are there. Whether all biryani shops operating in the same manner. Then the auditor can send the same checklist to all 100 biryani restaurants, the branches, 100 branches. Are the purchases centralized? Whether it is from approved suppliers, is the list of approved suppliers maintained? Does the master list contain more than one source of supply? So all these questions will be asked there. So each branch manager will have to give an answer for all these things. Then the internal auditor will collate and see where there is high risk, low risk. Based on that, he will go ahead and do an audit of that particular branch. These are all examples of the questionnaire. What is the flow chart? You would have seen a flow chart from your school days. It will start and then it will go through a process and then decision will be taken, a rhombus will be drawn, yes or no. And based on that, it will go to right or down or left. So based on that, further procedures will be done. So this is an easy way for an auditor to see whether the controls are in place or not and where he has to focus. Testing of internal control. The test of internal controls can be done in two-step process. First is design of the accounting and internal control system. Then operation of the internal control throughout the period. Design means whether it is properly designed to address the risk. Operating effectiveness means whether it is operating effectively or not. Say for example, to save the cashier desk. What is the risk? Somebody can run away with the cash. What is the control put in place? Look at the documentation itself. You see that the security guy is put, armed security guy, 2 armed security guys are standing outside the cash counter. And 4 CCTV cameras are placed in that area. And every day evening, the cashier is giving the cash denomination count to the accounts manager who is reviewing and closing. 3 controls are put in place. Now looking at that, you see that, okay, cashier cannot take the cash and run away because the accounting manager is reviewing. Okay, design is good. And nobody else can come and run away with the cash because 2 security guards are sitting there. And on top of it, there are 4 CCTV cameras. Even if somebody is running, you'll be able to catch them. So design is very good. Once design is good, pass, then only you'll go for operating effectiveness testing. You go for operating effectiveness testing means on 4 different days you go there and check whether it is operating correctly. Evening, whether every day the manager has reviewed and signed the denomination paper. Yes, 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 yes. Then it's good. But if the manager is not at all reviewing, control is there, but it is not operating. 3 days he has not signed out of the 4 days you have reviewed. Okay, it's failed. And security guards are there, but they are not there for the entire 10 hours of operation. They are only there for 4 hours. And balance 6 hours, somebody can run away with the cash. CCTV camera is there, but the footage is not being captured properly. There is no clarity in the CCTV camera. Then it's again failing. So once the design is passed, then you go for the operating effectiveness testing. You take some samples of number of days, and then you check how many days are passing. So based on that, you are concluding the testing of the internal control. What is an automated environment? It enables the faster business operation, accuracy in data processing. All these things we know from our past. Okay. Understanding and documenting automated environment. What is the information system being used? What is their purpose? What is the location of IT system, whether it is locally placed or globally placed? Architecture, version, interfaces, how many systems it is connecting to, whether it is in-house or packaged, outsourced services, key persons, all those things we are reviewing. What are the risks coming from the IT systems? Inaccurate processing of data, unauthorized access to data. See, earlier, if the data is manual, only if somebody enters our building, they can take the data, take the paper, take the file. But now, since everything is online, or since everything is in cloud, person sitting in Zambia, Namibia, and some African country and European country can take the data because it is all in cloud. So the unauthorized access of data is gaining more global kind of a risk. So it has to be addressed. The direct data changes, back-end data changes, excessive access. Because earlier only that department people will have access to that department. Now a super user, a super admin can access all department data for doing some software changes. So what if that guy, super user, is doing something with that? That had actually happened in Satyam's case. Ramalingam Raju, Satyam, wanted to add 13,000 ghost employees. He did not go through the regular process. He just called the super user or the admin guy, IT admin, and added 13,000 employees into the system and put one single bank account to all 13,000 employees, which is his account, and got credited. So this super user and excessive access, privileged users, all those things has to be checked. Lack of SOD, segregation of duties, unauthorized changes to system. Somebody goes into the system, changes it, and puts it to the bank account number alone. They change it to their account, and they are getting credit fraud. Failure to make necessary changes to systems or programs. Loss of data. All these are IT related new risks which have gone. So impact of IT related risk. So we need to do the substantive checking. Now it is in a different way we need to do the substantive checking. Inability to address about discussed risk may lead to non-reliance of data. All information, data and reports would have to be tested thoroughly for their completeness and accuracy. It could lead to increased substantive checking. Detailed checking has to be done. Impact on controls. If there is a non-reliance on automated controls, then he has to do more control checking. So it results in additional audit work. Impact on reporting. Due to regulatory requirements in respect of IFC, it may lead to modification of auditor's report in some instances. See, internal financial control, ICO for internal control for financial reporting is another report which the auditor will have to sign while he is doing a statutory audit signing, saying that whether internal controls are operating effectively as intended. If it is no, then the audit report itself will become as a modified report. That is what they are saying there. So now, types of internal control, IT audit control, like say IT control, you can see general IT control or application control or IT dependent control. General IT control is something like if you take your mobile phone, on your mobile phone you use your password to enter into the system. So that is your general IT control. For any kind of application, the same password is applicable. Right. Now, if you look at the next one, the application control, you go to ICICI Bank. For that banking app, you put a particular password. that is a specific application related control. IT dependent control is something like you will have that particular IT enabled or dependency to do that particular control. So now general IT controls like say data center, network operation, program change, access security, application system acquisition, development, all these things you are doing it for all applications put together. That is why it is general IT control. Application control, for that specific application you are doing having a control. IT dependent controls, manual controls that make use of some form of data. Even though the control is performed manually, the design and effectiveness will be dependent on the source of the data. Say for example, you are doing a bank reconciliation statement. So you are doing manual bank reconciliation from this system versus bank. So now this system report you are generating from the system and taking it out, and bank is giving the bank statement. Now you are relying on the system generated report to do your reconciliation. Even though it's a manual control, it's an IT dependent control. It depends upon the IT's output. Characteristics of manual and automated elements of internal control relevant to the auditor's risk assessment. Controls in a manual system may include such procedures as approval and review of transactions and reconciliation and follow-up. Controls in IT systems consist of a combination of automated control and manual control. See, for large, unusual or non-recurring transactions, you will use manual control. Circumstances where errors are difficult to define, anticipate or predict, manual control. Changing circumstances, manual control. Monitoring the effectiveness of the automated control, you need to do a manual control. High volume, recurring controls, you can put automated controls. Control activities where the specific ways to perform the control can be adequately designed, then you can put automated controls. Audit approach, as I told you, first you do a risk assessment, then you understand and evaluate it, then operating effectiveness, then reporting. So this is basically your design testing, understand and evaluate, and then you are doing your OE testing. Data analytics for audit. Check completeness of the data. Selection of the audit samples, random sampling, systematic sampling, recomputation of balances, reperformance of mathematical calculations, analysis of journal entries, fraud investigation, evaluating the impact of control deficiencies. So as an auditor, you can utilize data analytics, CAD tools like IDEA, ACL. You can use these tools and do some kind of a data analytics for the audit. Say for example, in the case of purchase orders raised after the invoice date, that is actually a normal testing done in the purchasing team to use the data analytics, take all the 100,000 records of purchase orders, 100,000 invoices, match them, compare what date is before, what date is later, come over the report, see which is unauthorized purchases. Digital audit, a small topic given there, you can go through that. Internal financial controls as per regulatory requirements, IFC. So listed companies that the director's responsibility state that the director has laid down the internal financial controls to be followed. 143.1. Auditor's report should state that for these kind of companies, the operating effectiveness of such controls are fair enough, internal financial system in place and also on the operating effectiveness of such control. For which companies more than 50 crore turnover. And at any time they have in the previous year more than 25 crore external body loan, maybe bank or financial institution. Documenting the risk. Auditor shall document the discussion among the engagement team, key elements of the understanding obtained from each aspect of the entity, identified and assessed risk of material misstatement, risks identified and related controls. Assess and report audit findings. Are there any weakness in IT control? What is the impact? Report the deficiencies to the management. Communicate in writing over significant deficiencies to TCWG. All deficiencies you'll put to management, but significant deficiencies only you'll take it to TCWG because they are senior people. Auditor's response to assessed risk. Objective of the auditor is to obtain sufficient appropriate audit evidence about assessed risk of material misstatement. Design and implement overall responses to address them. Perform further audit procedures. Likelihood of material misstatement takes into account the relevant controls. Determine whether the controls are operating effectively. Obtain more persuasive audit evidence. See, pervasive is different, persuasive is different. Pervasive is cutting across. Persuasive means it is convincing, more convincing audit evidence. The auditor shall design and perform tests of control to obtain sufficient appropriate audit evidence to the operating effectiveness. Unity of the controls. Consistency, how the controls are applied at relevant time during the audit period. The consistency with which they are applied, by whom or by what means. Determine whether the controls are to be tested depend upon the other controls. Indirect controls. Okay. Timing of testing of the control. If the control is more risky, it has to be tested closer to the year end. Say for example, inventory valuation 31st March. You need to go on 31st March and do it. Other control you can test before or after. So timing of test of controls is also important. Using audit evidence obtained in previous periods. Last year you got some kind of information that you can use it. Evaluating the operating effectiveness, specific inquiries by the auditor, and deviations are detected, and test of details. Okay, let's quickly check what are the other things there. With that, I think we are coming to the end of the topic here. So this last 1 or 2 pages, let's quickly understand what they are saying here. Evaluating the operating effectiveness. Absence of misstatement detected by the substantive procedure, however, does not provide audit evidence that the control related to the session being tested are effective. Material misstatement detected by the auditor's procedure is a strong indicator of the existence of a significant deficiency in internal control. In deviation controls upon which the auditor intends to rely are detected, the auditor shall make specific inquiries to understand these matters and their potential consequences and shall determine whether the test of controls that have been performed provide an appropriate basis for reliance of the control. Additional test of controls necessary, potential risk to the misstatement. Test of detail means you are testing the details of a transaction or details of that particular line item. Vouching, verification, all those things you are doing. Substantive analytical procedures is basically the analytical procedures you are doing, ratio, trend analysis, and last year comparison. All those things are the substantial analytical procedures. So auditor's response to assessed risk, either it can be test of control or substantive procedures. In substantive procedures, it can be test of details or analytical procedures. In test of detail, it can be test of transaction, which is vouching, or test of balances, which is verification. Okay, with that, we have come to the end of the topic. Any other questions you have?
No, sir.
If no questions, I would request you to go through all the... No, okay, great. I would request all of you to go through all the jargons and terminologies used in this particular topic and make sure that you are understanding it clearly and memorizing them and writing it in your exams. So if your jargons are right in audit and your approach is right, you will definitely be able to pass the exam. All the best for your exams. Take care.